Tyler, welcome. Interesting balance of risks here. You've got a comparison with the S&P, which has been kind of propped up with bigger tech, and you think some of certain software names look attractive here versus that?
Yes, that's right. And thanks so much for having me. Good morning and happy holidays. So, I think as you mentioned, the S&P earnings growth by and large has been, the outsized contribution has come from some of these large tech firms like the Salesforce.coms, the Microsofts, the ServiceNows. And if you kind of strip out the non-tech names, the revenue growth and earnings growth is significantly lower than obviously the software sector. And so, we think if you take a step back and you look at a name like Microsoft, for instance, you're not paying 2 times the valuation multiple as you are for the S&P, but you're getting more than 2 times the revenue growth and earnings growth. And, we just think as you look at what's happened throughout prior downturns, the resiliency of software has definitely held up. And so we think that can continue to take the sector higher into next year.
Tyler, though, I wonder what's normal. Some of these valuations are pretty high, both for big tech in the S&P and for the likes of MongoDB and Snowflake, even though they've come off a bit. So what qualifies as an attractive entry point when we don't know what demand is really going to look like in 22?
Yeah, so it's a tough question, right? What's about calling the bottom in the hypergrowth software sector? I think if you focus on fundamentals, companies that we expect to have, robust selling conditions next year, maybe driven by company specific, business models that are seeing reaccelerating growth. We think those are the names you want to own. For instance, you mentioned MongoDB and Snowflake. Those are names that we think can really differentiate themselves versus the rest of the sector. They kind of play into this theme around the refactoring or recreation of companies' data architectures, which, based on our work, we think is going to be a really important theme next year. And our analysis suggests that both these companies can sustain devaluations in their forward revenue multiple and still outperform, just because revenue growth is so much higher. And so we think that those are names that look interesting here on the pullback.
Tyler, in your note, you talk about the most debated names, the most controversial names in the sector, and Salesforce is one of them. Tell us a little bit about this category and where you come down on some of these stocks and what it'll take to convince you that a Salesforce, which is down 2% today, could be a buy going into next year.
Yeah, so Salesforce has been an interesting one. I think investors have historically been concerned around the lack of margin expansion, and what we saw at their analyst day this year in September was a really strong message on expanding margins, pursuing some kind of sustainable cost cuts that should lead to really strong margin expansion next year. The issue was when they reported their earnings in November, you got the margin expansion, but growth came in a little bit lower than expected. And so it just kind of feels like the company hasn't been able to string together both the growth and margin expansion. So that's what we're really looking forward to into next year. Right now we think there's better opportunities at other names, and so we have a neutral rating. But we're kind of looking for that organic growth plus margin expansion at Salesforce.